This week in Space and Money, here are the latest updates shaping the new space economy. Over the last 7 days, the story was not just rockets or satellites in isolation. It was capital formation, defense demand, launch economics, orbital infrastructure, and the steady migration of space from a frontier narrative into a serious financial sector. In the next few minutes, I will walk you through the biggest developments, explain why each one matters, and connect the dots so you can see where momentum is building next. The reason this week stands out is that nearly every major layer of the market moved at once. Public markets rewarded scale, private investors kept funding hard problems, governments wrote new checks for resilient infrastructure, and global institutions from Tokyo to India signaled that space is no longer a niche theme followed only by specialists. If you care about where capital, policy, and technology are reinforcing each other, this was one of the clearest weeks yet. The biggest headline still starts with SpaceX. After its public debut, the stock jumped 19% on day one and closed around $161, instantly making SpaceX one of the largest public companies in America. That matters beyond the pop itself. For years, space investors talked about a missing benchmark. Now public markets have one. Once a sector has a giant liquid anchor, analysts, index funds, and generalist investors can begin pricing the rest of the ecosystem against something real. The second signal came from ICEYE, the Finnish radar satellite company that raised fresh capital at a valuation north of 10 billion euros. The deeper story is not just a financing headline. It is that synthetic aperture radar is turning into sovereign infrastructure. Governments increasingly want persistent imaging they can control, not simply data they rent occasionally. That shifts satellites from a software-like subscription story into a strategic asset story. And strategic assets usually attract larger, longer duration pools of capital. Another telling move came from New Orbit in the United Kingdom, which raised $18.5 million to pursue very low Earth orbit operations. VLEO is one of those ideas that sounds simple until you remember the physics. You get closer to Earth, which can improve imaging resolution and reduce latency, but atmospheric drag becomes brutal. Investors backing this category are not chasing a simple app story. They are underwriting propulsion, materials, and orbital operations. That tells you capital is still willing to fund deep technical edge where the upside could define an entirely new operating layer in orbit. This week also reinforced something important about market structure. More space names are being pulled into mainstream equity plumbing through index inclusion and broader investor attention. When space companies enter widely tracked benchmarks, ownership expands beyond enthusiasts and specialist funds. Passive money has to follow, liquidity deepens, visibility improves. That does not remove volatility, but it does change who is in the shareholder base, and that is a major shift if you believe space is graduating from a story stock category into a durable sector allocation. Underneath all the excitement, the launch market keeps acting like the toll road of the entire space economy. Research this week pointed to a launch services market near $13.9 billion this year, with strong growth continuing through the decade. That makes intuitive sense. Broadband constellations, defense payloads, Earth observation fleets, servicing missions, and station modules all depend on getting mass to orbit at the right time and at the right cost. Whoever builds reliable launch capacity does not just sell flights. They own the gateway that every other orbital business depends on. One of the most underrated updates this week involved in orbit servicing. A $30 million mission is set to grab NASA's Swift telescope and lift its orbit, extending the life of a spacecraft that has been operating for more than 2 decades. This is the kind of development that sounds small until you think about the business implications. If you can reboost, refuel, reposition, or repair valuable assets already in orbit, then satellites stop being purely disposable hardware. They become serviceable infrastructure, and serviceable infrastructure usually creates recurring revenue opportunities. On the government side, the U.S. Space Force awarded Lockheed Martin more than $514 million for 2 additional GPS satellites, The easiest way to read that is as another defense contract. The better way to read it is as proof that the most durable space businesses are often the ones that get purchased again and again because they underpin modern life. Positioning, navigation, and timing support, precision warfare, logistics, transportation, agriculture, payments, and consumer apps. When resilience against jamming and spoofing becomes more urgent, that replacement cycle only gets more valuable. Commercial space stations took a major step forward when Axiom Space closed an expanded funding round totaling $525 million, with Japan's largest bank among the investors. That is an important credibility signal. For years, private stations were easy to dismiss as a distant concept. But as the International Space Station approaches the later phase of its life, somebody has to build the next habitat layer in low Earth orbit. When global banks start underwriting that future, it tells you the station economy is beginning to look bankable rather than hypothetical. Rocket Lab added another concrete data point for investors who want operating evidence, not just narrative. The company reported record quarterly revenue and a backlog that jumped to roughly $2.2 billion right before its move into the NASDAQ 100. Backlog matters because it converts excitement into visible future work. It suggests customers are already lining up missions, spacecraft, and related services at scale. In a sector often criticized for being long on promise and short on cash flow, that kind of number earns attention from a much wider class of investor. At the macro level, the boldest framing this week was the projection that the global space economy could approach $1.8 trillion by 2035. Whether you use that exact number or not, the direction of travel is what matters. Cheaper launch, more connectivity, rising defense spending, and stronger orbital data demand are combining into a market that is broader than most people realize. This is no longer one bet on one rocket company. It is infrastructure, data, manufacturing, defense, robotics, communications, and financial markets starting to reinforce each other. Two more stories rounded out the week. India opened a 500 crore technology adoption fund and made its first Space Tech Awards, helping seed domestic capabilities in imagery, propulsion, and spacecraft systems. At the same time, public market investors kept looking beyond SpaceX, with several listed space names up sharply this year. Put together, those signals matter. One says new national ecosystems are being built from the ground up. The other says capital is rotating within the sector instead of leaving it. That is how an industry develops depth. So the big takeaway from this week is simple. Space is becoming a real capital market, not just a technology curiosity. The winners will not come from one lane alone. They will emerge where launch, defense, satellite stations, servicing, and public markets start compounding each other. If you want to follow the new space economy intelligently, do not just watch launches. Watch where the money gets committed, where governments keep buying, and where infrastructure starts becoming indispensable. That is where the next durable value in space is being built.